Varun Dhawan, Head of Tax, India, South Asia and Oceania, DHL Group. Please welcome him on stage with a huge round of applause. Handing over the stage to Varun sir.
Good afternoon. So, Jigar, that was a very interesting session. I've never seen an interactive session the way you guys did it. So, thank you. Shifting gears, we get into the corporate tax and the direct tax, where we are going to first see my session is on navigating challenges of the corporate tax and transfer pricing, and I think after that there are two more sessions on Pillar 2 and tax litigation and on the DTAA and tax treaties. So I'm going to cover on the corporate tax and the post-BEPS challenges. So I was given two topics, that's international tax and one was on tax organization. So on the international tax, it is challenges and opportunities under the post-BEPS world. And for the tax organization is that how digitalization is reshaping the corporate tax function. I think over the last few hours, we've heard a lot about how digitalization is shaping the future of tax organization. And probably you will feel something is repetitive, but I'll try to be short over there and cover more on the post-BEPS world. So on the challenges and opportunities in a post-BEPS environment, let's first understand the key principles of taxation. So what are the key principles of taxation that any tax system or a tax law should have in a country? There should be 4 pillars to it. That is, it should be fair. That is called as fairness in the horizontal equity and vertical equity. Horizontal equity means that if you and I earn the same amount of income, both should pay the same amount of tax. And the vertical equity is that a lower earner should pay a low amount of tax and a higher earner pays a higher amount of tax. Tax system should be efficient, and there it is about it should not alter the behavior of a taxpayer such that whether there is a tax or no tax, high tax or low tax, his decision making should be the same. That is the proof that the tax system is efficient. Third is the tax system should be certain, that it should be clear to understand both for basically for the taxpayer, he should know how much he has to pay. And the last is that the tax system should be simple and straightforward and easy to understand. It's anybody's guess if our tax system is really simple, and we hope that the FM is going to release tomorrow the new direct tax bill, whether it's going to really be simple or no. There's a lot of talk about it. But I have a take on that simplicity. It's not about the law to be simple, it's about the mindset of the tax administrators who administer that law. You know, they need to have the mindset to read it the way it is to be read and not read too much into it, because even when GST came, we all know it was said that it's going to be independence from the old regime and all of that. And all of us know how the GST law is getting administered and the audits, and we saw that mock session of an investigation. It really happens that way. So it's the same old wine in a new bottle, nothing else. So this was just to lay the foundation, what should a tax system be, and then we get into what has happened. In the last decade, if you see the tax system, at least on the global front that I'm talking about, it's been an enormous change of things that happen, and it's changing at such a rapid pace. I have covered here how it has changed in the last 10, 12 years. And I call it the VUCA world of taxes because it's really pretty volatile and uncertain, it's complex, and it is as ambiguous as it can be. And there's no stopping to that. So in 2012, just to give you a history of why did BEPS come up and what is the post-BEPS world like. So in 2012, you had a lot of newspaper articles specifically of the UK-based companies that they are not paying their fair share of taxes, that's Starbucks, Amazon and Google. I'm sure we all have read about it, that there was a lot of backlash on these companies that they're earning a lot of income from these countries and not paying their fair share of taxes. And then there was a whole debate on ethical tax versus moral tax, and that debate continued until OECD stepped in. And then they said that, the EU stepped in, the European Commission, and they wanted to crack down on these harmful tax competition that was then happening in the world. And since then, the OECD and G20, of which even India is a part, we've made several policy announcements in the pursuit to make the tax system globally much more fairer, such that every company pays their fair amount of taxes in the jurisdiction from where they get value. So that was 2012 what happened. In 2013, and how it then panned out is that in 2013 we came with the BEPS 1.0, that's the 15 action points which the OECD came with, right from digital economy to the country by country, thin capitalization. There are 15 such action points, and the countries were asked to implement those to the extent that they can. These 15 action points were finalized in 2015, and that was the time when even India, so one of the action point was dispute resolution, and India went ahead and we introduced the advance pricing agreement, so where you could go to the tax office in advance and get a ruling on the international transaction which you have with your associated enterprises. 2016, BEPS, the OECD launched the inclusive framework which allowed countries to collaborate in implementation of the BEPS measures. And so that was basically a dialogue for countries to come together and start implementing. And of course, India was very concerned about the digital economy. There was no consensus reached on digital economy, how the digital economy should be taxed. And India was probably the first country that went ahead and introduced the equalization levy in 2016 on advertisement services, the online advertisements. That's basically your, when you go on Google and you get those ads whenever you do a search. So India went ahead and taxed because they said the Indians are consuming that advertisement, so pay a tax. The tax rate was 6%. India also introduced the CBC reporting, that's the country by country reporting, that was part of the, and also we had the mutual agreement procedure which we introduced for dispute resolution between two countries for the ongoing disputes. So APA covers the in advance and the MAP is to cover the transactions which are already disputed. 2017, you had the MLI, the multilateral instruments, which the OECD wanted all. They came with a draft that, okay, they came to a conclusion that the tax treaties are being abused, and all countries are not at the same level on the tax treaties, and to get some kind of a consensus on all the treaties, they came with this multilateral instrument, and it allows the country to amend the tax treaties and implement the BEPS. So at the least, these MLI had two clauses, the principal purpose test, which is the main one, and one was on the MAP. So the principal purpose test is that it's basically an anti-treaty abuse. If the tax authorities find that one of the reasons was to treaty shop or to take advantage of the tax treaty, then that would be disregarded and you would not get that benefit. So that's a significant change that came in the MLIs. This MLI was a pretty fanfare event that happened in Paris. 80 countries signed that MLI, and in India also went and signed that. And in 2017, in the budget, we also introduced thin capitalization rules, which was part of the BEPS 1. That's basically to disallow companies to push in a lot of debt, so that if there's a section 94B which says that only 30% of the EBITDA would be allowed as the interest deduction. The balance gets disallowed and you carry forward to the subsequent years. This is only on the foreign debt. In 2018, India introduced the significant economic presence. They basically extended the definition of what is a business connection. That's section 9. It's fairly large. And India came with a very small threshold. It's about if you are generating revenues with a business connection in India, I think of 2 crores, 20 million, you would be considered to have a significant economic presence in India. Or if you have a customer base of, I think it's 3 lakh. Yeah, so it would be treated as you have a significant economic presence in India, and then you would need to file your tax returns or whatever. 2019, India ratified the MLI, so we adopted the MLI, and of course, 2 treaties where we had an issue as taxpayers we were not sure was on Singapore and Mauritius, because both these treaties had a grandfathering clause already agreed by India. So it's only recent as last month last month that CBDT issued an instruction or a clarification to say that the grandfathering clause will not get impacted by the PPT under the MLI. 2019, what we also did was there was an automatic exchange of foreign account information, and this became the new norm. I don't know if any of you have invested in foreign equity markets, or your executive employees would have invested. You would have seen some bit of action over there, where at least we saw where we give ESOPs to our executives, and the executives got notices under the Black Money Act saying that you have made these investments but you did not disclose in the return, because if you see your return form, there is where you need to declare your foreign assets and foreign liabilities and your foreign bank accounts. So all that information is in reference to this, the Black Money Act, and then the exchange of information, where they were exchanging information with the countries to match and then issue notices. And then of course the OECD began the discussions on the digitalization of the economy and the tax challenges arising out of digitalization. They've yet not concluded how the digital economy should be taxed. So it's basically there's so much of change that keeps happening each year that you really cannot keep pace with it. It doesn't end there. In 2020, India went and extended the scope of equalization levy, and we covered all e-com supply of supplies and services to be covered under the equalization levy. What India did was we reduced the rate of tax to 2%. And then we had the Pillar 1 and Pillar 2 which came up to address the challenges of the digitalization and a global minimum tax. This was the framework which was announced. I think we have a next session by Kapil on Pillar 2. I think he would cover, but Pillar 2 is basically that global minimum tax is 15%. A lot of countries have implemented. India's yet not gone ahead because we don't see that need. And Pillar 1 is something for redistribution of tax to the markets where the business, the value gets created, the intangibles and the profits. That's some time away because there is still no final conclusion on the Pillar 1. So as I was saying, in 21 you had 130 countries who have agreed to adopt the Pillar 2 solution to address the challenges, and that's the BEPS 2 framework, which was finally agreed by all the 130 members, OECD and G20. And 22, they released the final report on implementation of the Pillar 1, Pillar 2 and the guidance to the countries how this should be adopted. Within a year, you've got 30 countries, the large economies who've already gone ahead and enacted Pillar 2. It's become effective from Jan of 2024. And in 2024, we also have another 20 countries like Australia, Singapore, UAE, who have announced that they will introduce it in Jan 25. So you have a lot of traction that you're seeing that countries are going ahead and adopting the Pillar 2 approach. And of course, in 24, you also have India, which withdrew equalization levy. The equalization levy has been withdrawn in preparation for Pillar 1, which would come in. So that's what India did, and I think there was a lot of pressure that India should withdraw, and I think rightly so we did that. And also there was not much amounts that the government were able to collect on the equalization levy. 2025, we are just about 6 weeks into it, and we have the clarification which I told you about the PPT, which was issued by CBDT. And interestingly, we also have the OECD, which has released the administrative guidance of how the reporting has to happen. They've come out with something called as a Globe Information Return. That's basically the GIR, and there's a XML schema, the way this information would need to be captured and filed as part of the multilateral, as part of the BEPS project 2. And there is also, they've set up a multilateral competent authority where you could, if you have any issues, you can reach out to them. And interestingly, as President Trump has come, he has issued an executive order. He has withdrawn from Pillar 2, and he has said that US is withdrawing. And he has also gone ahead and said that if any country goes ahead with this, from Pillar, on the 2, he's withdrawn from both the 2 pillar approach. And if any country tries to put tax on the American companies, he is going to come with retaliatory tax provisions. So there's a lot of flux about how this will work. I think Pillar 2 is still fine. Pillar 1 will take some time, because if US does not participate, then there's an issue for the whole world if they don't share their profits with or the taxes with especially the developing countries. And of course, I ended there, but you also have your tariff war, which has started in the last 2 days. Today he's announced tariffs on China of 10%, so you really don't know how this all is going to pan out to be. So this is the tax world that we are in, specifically on international tax, of how things change every year, and to keep pace with it, right from, you have your CBC reporting, or a transfer pricing resolution, or a thin cap agreement, thin cap, how do you compute? You have equalization that comes in, equalization that goes out. So it becomes challenging, and also, of course, there is a lot of exchange of information that happens, and we've seen that happening across countries where you have the exchange of information is pretty much live and kicking. To give you an example, For our group, we are in 220 countries, and it's an extremely challenging project to get ready for this reporting, because there's so much of data that needs to be churned out to comply with these regulations. So I think we started 2 years back to get ready for this. So what are the challenges that we see in this post-BEPS environment? So of course, there's complex regulations. I haven't gone into the pillar 1 calculation because, and anyways the bell has rung. Pillar 1 is so complex to compute. I think it needs a couple of hours to understand how that redistribution happens. So there's a lot of complexity in complying with these regulations. Evolving tax policy, it's evolving. You saw every year it's evolving. And digital economy taxation is that it's really impacting that the tax professionals, you really need to be updated with what's happening in the international taxation on the digital tax side, because you also have France, which has some digital tax, and UK also. Global coordination is a must, because you cannot work in silos. If you are in a MNC, you need to coordinate with your colleagues across the world, because the government is exchanging information, so you better be clear within your organization of how you speak one voice when you report something. TP compliance, I think there's no understatement to say that documentation is the key. I've seen a lot of times where we do DP compliance, we say documentation baad mein karenge, but that baad mein never happens. So it's really important that you get that done. Litigation, dispute resolution, I think choosing the right litigation strategy is the way forward. You've got the APA, you have a map, you need to decide how do you want to select. Now you have the TP, which is FM announced in the budget of the block assessment for TP. That's a new thing which has come up. So you need to decide how you want to handle your TP litigation. Data security is a key, because there's a lot of data going out to the government. How do you secure data when you report, and also within your teams, because your teams are privy to a lot of confidential data. Adoption of new technologies is about being agile and be ready for adopting new technology, and that's something which we've heard throughout the day also today about technology, but more on the GST side it was. Capacity building and skill development, it's about the teams, your internal teams. I think you need to invest in your teams, you need to build capacity, and you need to upskill that team if they need to. And stakeholder communication I think it's pretty crucial, because sometimes businesses don't understand the complexities and the nuances of the tax, especially in the global environment. Because I can tell you from my experience, I can tell you from my experience that the way India looks at things is not the same lens with which Germany may look at things. So it's really important to communicate to them how things work in India. So that's about it. And overall, in a post-BEPS world, we all must be proactive, adaptable, knowledgeable, and navigate this post-BEPS world landscape. So I have another one on, there are opportunities, as well. Tax-based, this is more from a government perspective, the opportunities, the first two, and this one is on the startups, that the startup business would now be able to compete with the Western world. So because each one pays the fair share of taxes from where they generate. So I think it's going to help us, the startups, and also there will be FDI coming into countries like India, because you would have more clarity on what is the right amount of taxes you pay. So those were the opportunities, and this is the second part. I'm going to take only 2 minutes. I'm not going to go into what the government is doing on data. I'm sure all of us know. I was told to cover what's the future of tax organization and what are the challenges, and I think I could list down 4 key challenges is the compliance challenges. How do you keep pace with the compliance in GST and income tax and transfer pricing, and now you also need to read sometimes the FEMA and the RBI into the tax. So those challenges. Technological challenges, the way the GSTN or the income tax portal keeps updating technology, we need to keep pace with that. And of course, on the data security, less said is not enough, and we all need to have digital infrastructure. Operational challenges is more about training and skill development of our teams and use of smart intelligence. I have used AI, it's really brilliant. I think you guys must try, not for making submissions, but generally I always encourage my team to use AI, it really helps you. And of course, we need to always be conscious on cost because you have a lot of technology, but you need to be smart to pick up what is right for you because in the end, you have the CFO who has to be answered what is the ROI, and you can't just buy any technology. So, and of course the last one is the key one is external advisory costs. They're always there to give you all kind of fancy structures, so you need to be smart to select the right one. Thank you.